We also said there are certain approaches. What are those approaches? The first approach is called demand-based approach. Clearly, this approach is finding a balance between the theoretical aspect that we are studying and what can be put into practice. How is it done? This is a beautiful concept which always tries to connect the price, the quantity demanded and sold, and the total revenue, which means the focus is more on demand. How much there is a need for the product. That is the concept that this goes by. And therefore, there is a high possibility of arriving at a profit maximizing price or a revenue maximizing price. To continue further on this concept, demand-based approach, this approach always looks at the demand condition. It always looks at the competition in the market. A beautiful concept, that has, been brought forward to us. Let's take an example. There is a transport company which wants to consider increase in fares. Therefore, what should the transport company do? The transport company should first estimate the knowledge of demand. And the transport company believes that the demand will not be affected even if it increases the fares. This is what we call as a demand-based approach. Full cost plus pricing. A very simple concept where an organization will first look at what is its fully absorbed production cost. And once it finds that, it will base its price based on the fully absorbed production cost. Or it may also include some of the SDA. What is SDA? Selling expenses, distribution expenses, administrative expenses. So it can also add some of the SDA and then find out what should be the full cost plus pricing. What are the benefits? If the company is working at a normal capacity where you will absorb all your fixed cost, it is so easy to make a profit based on this. What is the other benefit? This is a very, very simple way of calculating, and therefore this can be done so easily. Therefore, even your junior staff, can be engaged to carry out this exercise. But is it as simple as it sounds? Let's look at this. There are some problems. What are the problems? See, it is always difficult to arrive at a profit maximizing price because if you don't know the demand, how can you fix the price? In the earlier approach, which was demand-based approach, it was so beautiful because entire focus was on demand. But here is a concept which first speaks about the full cost and then determines demand. Quite an opposite thing. Therefore, it becomes difficult to get to the profit maximizing value. And prices must always be adjusted to the market conditions, to the demand conditions. And finally, how can you make a decision without knowing the demand? And how can you ascertain a demand without clearly coming out of the price? So there is a dichotomy here. But then this is one of the approaches which is still used, and it depends on how the market prevails for the success of this concept. Another interesting approach is called marginal cost plus pricing. This concept is also called markup pricing. What is markup? A markup is a profit which I add on top of my cost. So a profit margin is added to what? It is added to the marginal cost and not the fixed cost. That's why it is called as marginal cost plus pricing. Are there advantages? Yes, look at this. You can always change the markup based on the market situation. More important, if your variable cost is easily identifiable, this concept is very, very convenient. So if your marginal cost, if your variable cost can be easily identified, this comes very, very handy. But then there are problems also associated. What is those? Attention may not necessarily be paid to the competitor's price or also to the demand condition for profit maximization. That's one of a big fall through that can happen on this mechanism. Sometimes you can ignore your fixed cost, and if you ignore your fixed cost, if you don't absorb your fixed cost, obviously it can lead to losses. So these two are high cautions that we need to bear in mind whenever we look at this concept. Opportunity cost approach. Now, Opportunity cost approach can be adopted for both a full cost plus price or a marginal cost plus price. But then the important question in front of us is, what is this opportunity cost? An opportunity cost represents the net benefit which is lost by rejecting some other alternative course of action. So, when you reject an alternative course of action, whatever is the loss, that is called as opportunity cost. Let me give an example. Let's say you love movies and you want to watch a movie, but then there is this examination. So you have to spend some time for exam because you want to get better grades. Therefore, you avoid going to the movie because you want to study and get better marks. Now, the fact that you sacrifice that movie is actually the opportunity cost. Therefore, opportunity cost is also sometimes called as sacrifice cost, because you are sacrificing something to achieve some other aspect in your life. Now, this opportunity cost is very, very significant, because what it does is only the best decision is looked forward to. For example, exam is important than the movie. So always the best decision is taken care of. Therefore, since you choose the best alternative, it always takes care of the costs which are associated in a decision. There is another concept called fixed price tenders. And as the name suggests, the price is fixed. Why do we do it? One classic example is you want to take a special order. Why do you want to take a special order? Maybe you have excess capacity, you want to utilize that. Or maybe here is a situation where you have overheads to be absorbed and therefore you want to use this concept. Therefore, it's like a one-off revenue earning opportunity, an example of fixed price tender. Another reason why you want to use this is to at least charge minimum price, because you want to ensure that your incremental cost and your opportunity cost are fully absorbed. So that's one more reason why you can use a concept of minimum pricing as part of the fixed price tenders. There are certain qualitative and quantitative factors which we should always bear in mind whenever we are using a fixed price tender. What are those? One is, do we have precedent to agree on this fixed price? Because if you don't have precedent, how do you come out with a fixed price? Justify. Will this project enable my employees to give that much time to complete the project? Is a big question mark. That has to be answered. And if there is a cost overrun, can we recover those costs? Is another important aspect, because you have already fixed the price. Therefore, how do you manage your profits? So there are certain qualitative and quantitative factors which need to be borne in mind before you come out with a fixed price. And you have to monitor the cost. Why? Simple case, if there is a cost overrun, how do you manage? How do you absorb that into your business? Because it's going to impact your profits big time, because your price is fixed. Therefore, all these factors need to be borne in mind before you come out with the fixed price tender. To sum up, what have we read today? We first saw that there is something called price elasticity. To give this as an example, if the price of carrots move up, you will always look for some other vegetable which has got a lower price so that you can meet your demand, which means the simple concept that we know is, if price goes up, the demand can come down and people can look for substitutes. That's what we call as price elasticity. Here is a situation where it's a case of fixed price. Once the price is fixed, you can't do anything about it. You are completely tied down. Therefore, a lot of caution needs to be exercised before you come out with a fixed price. And then, here is a beautiful case of inelastic demand. Look at Starbucks as an example. If you're a coffee lover, if you're always focused on a brand, irrespective of whatever is the price, the quantity demanded will still be higher, which means even if the price goes up, the quantity also goes up. A beautiful case of inelastic demand. Therefore, price elasticity and the various approaches are quite important for us to understand whenever we come out with a price fixation. Thank you.